So the last new budget that we're going to touch on will be the balance sheet. So this is putting everything together. We're doing our balance sheet for the end of the period, so our balance sheet as of May 31st. So we're going to get all of these pieces from the other sub-budgets within the master budget. So starting with our cash, that should be coming from our cash budget. So if we scroll back up here, our ending cash balance is $2,950. So that is what we're going to have for our cash balance on our budgeted balance sheet. Accounts receivable, our ending accounts receivable comes from our schedule of cash collections. Go up here and find that. So that was our AR balance. So this was our schedule of cash collections. And this is the balance that we hadn't collected yet from prior period sales. So that's going to be our ending accounts receivable balance. Our ending inventory balance is going to come from our merchandise purchases budget. This is our material purchases budget, and this includes our ending inventory balance. So our ending inventory balance for the budget will be $40,000. Our ending building and equipment or ending capital assets will be coming from our capital budget. So if this were a more complex capital budget, you could possibly have things in here that weren't fixed assets, so you would need to pick certain items out of it. However, we've got a fairly simple example, and honestly, many companies for a capital budget do just have physical assets, so long-term fixed assets. So if that's the case, if that's all we've got, then we're just going to use this ending balance here. So our assets total $324,450. So now we're going to pull all our liability and stockholder equity item. Our accounts payable, that's going to be based on our schedule of cash disbursements. We're going to scroll up to find that. Here is our schedule of cash payments or cash disbursements. And our AR balance, the amount that we still hadn't paid out, therefore the amount that's still in our accounts payable ending balance is $72,000. And our note payable balance, also known as our loan payable balance. Remember, the term note payable in accounting or notes payable quite often covers loans, line of credit, any type of borrowing that you need to do. So to figure that out, we're going to start with our beginning balance for our notes payable and then look at our cash statement to see if we added or subtracted any additional borrowings or repayments during the period. So our beginning balance, I'm going to go up to my balance sheet at the beginning of the period, was $14,500. So that's what I'm going to start with down here. That was my beginning balance. And then if I look at my statement of cash flows or my cash budget, down in the financing section, I can see, did I borrow more? Nope. Did I repay anything? Yes, I repaid $500 of the principal. I also repaid the interest. Remember, interest is an expense. It's not a reduction of the principal of the loan amount. So all I'm going to be doing is I'm going to be subtracting this $500. So that's reduced what I owe. So I've just done this as a formula here. $14,500 was my beginning balance. Subtracting out the $500 payment I made gives me an ending notes payable balance of $14,000. Now my common stock, don't think we talked at all about changing common stock. Let's look in our cash flow, see if there's anything about selling or purchasing stock. Nothing in there at all. So we can just take our beginning balance and use that as our ending balance. We haven't made any changes in the period for our common stock. And then remember your financial accounting 201 or 202, retained earnings. That's your beginning retained earnings for the period. Add in any net income, subtract any dividends. So let's scroll up first and get our beginning balance. So our beginning balance of retained earnings was $42,500. So I'm going to start with that. And then I want to add in any net income. Here's my net income. And in our example, notice we're not taking taxes out. In a real world example, you would have one more line here for taxes, and then you'd have net income after taxes. And that is actually what you'd be using in your returned earnings right there. But we're simplifying it and removing the tax. And then the only other thing we would subtract are our dividends. So if we look at our cash budget, we can see if we're paying out any dividends. So nope, I don't see anything about any dividends being paid out. So our ending balance should be $58,450. And how do you tell if this is likely correct? Again, remember financial accounting, your assets need to be equal to your total liabilities and stockholders' equity. So these two amounts should be equal to each other. And if they are, there's a very good chance you've done the problem correctly. And that's the very last step of putting a budget together. So although our example has been pretty simple, what I really wanted you to see is the flow of it, how all these little sub-budgets come together to prepare the master budget. You need all these pieces to be done and done in a specific order to be able to prepare your master budget. If we look in, let's say, I think the one section that's really simplified is our selling and admin expense. This is where you get tons of information in your budget because every department in your company will have their own separate budget. So you'll actually probably have, depending on how many departments you have in a company, 20, 30, 40, 50, maybe even more separate budgets that will actually feed into the total here. So keep that in mind as well. But that gives you an idea of the overflow of all the separate budgets that go into a master budget, all the different components that need to be considered, and the order that they need to be prepared in. So that gives you the real world sense of how you would put one together.